So in 1929, the global economy wasn't destroyed by a catastrophic war or, worldwide drought.
Right, or some freak natural disaster.
Exactly. It was actually dismantled by 4 men in suits just sitting in quiet, wood-paneled rooms looking at ledgers.
Which is pretty wild to think about.
It really is.
Right.
We usually picture global apocalypses as these loud, dramatic events completely out of our control.
Yeah, but the terrifying reality of the worst economic disaster in modern history is that it was entirely man-made.
Driven by policies, misjudgments, and just a deeply stubborn belief in a financial system that had completely outlived its usefulness.
It fundamentally rewrites our understanding of how global crises unfold.
Yeah.
Like it changes the narrative from this unavoidable tragedy to a chilling case study in human error.
Because the decisions made by just 4 unelected central bankers pushed the entire globe into the Great Depression.
And the craziest part, they did it while genuinely believing they were saving the world.
Right. So welcome to today's deep dive. We are unpacking the incredible story of the Lords of Finance.
It's such a fascinating stack of excerpts we have today.
It really is. We're mapping out how this economic doomsday machine was built and how the people running it just refuse to turn it off.
Yeah, our mission today is to look at the mechanics behind the madness.
Like, how do incredibly smart people make such disastrous decisions?
Well, this deep dive is essentially a masterclass in the dangers of ideological rigidity.
Oh, definitely.
It shows us what happens when the world fundamentally transforms, but the people holding the levers of power absolutely refuse to adapt their rulebook.
Right, so to understand how these 4 men accidentally break the world, I feel like we have to look at the incredibly fragile playing field they inherited after World War I.
Yeah, we have to rewind to the early 1920s.
So the physical war is over, but the economic landscape is an absolute disaster. Europe is devastated.
Completely.
Germany is staggering under the crushing burden of massive war reparations that they simply cannot afford to pay.
And Britain, which for a century was the undisputed heavyweight champion of global finance, is desperately struggling to hold on to its dominance.
Because its empire is fracturing.
Exactly. And then France is terrified of another invasion, so they are obsessively seeking financial and physical security.
Right. Meanwhile, standing across the ocean, largely untouched by the physical destruction of the conflict, you have the United States.
Emerging as the strongest economic force on the planet.
Flush with cash, massive industrial capacity, the global balance of power had completely shifted overnight.
It had. And the fatal flaw was the mechanism they used to try and glue these wildly different, unstable economies back together.
Right, the gold standard. Let's really unpack the mechanics of the gold standard.
Sure.
Because we hear the term thrown around constantly in historical contexts, but it's rarely explained how it actually functioned as a daily operational reality for these countries.
Well, at its core, the gold standard was a system where every participating country's paper currency was directly tied to a fixed amount of physical gold.
So if you held paper money, it was essentially a receipt.
Yeah, basically. You possessed an ironclad guarantee from your government that you could exchange that paper for actual tangible gold from their vaults.
Which, sounds great on paper.
Right. It creates ultimate trust.
Because money isn't just a promise, it's a physical rock.
Exactly.
But if I'm understanding the mechanism correctly, it also places a brutal limitation on a government.
Oh, absolutely.
Under the gold standard, a country cannot freely print money to stimulate its economy or pay its debts.
No, they can't. The amount of money circulating in your society is strictly limited by how many gold bars are sitting in a vault.
Wow.
And that is the exact mechanism that drives this entire tragedy.
How so?
Well, if a country imports more than it exports, or if investors get spooked and move their money abroad, gold physically leaves the country.
Oh, literal gold bars are being shipped out.
Right. So to stop the bleeding and attract that gold back, the central bank has to raise interest rates, making it more profitable to keep money in their banks.
Okay, but raising interest rates slows down domestic business, right?
Exactly. It cuts wages, increases unemployment. It's painful.
So it acts like an economic straitjacket.
That's a great way to put it.
Like, if you have a patient who is acting recklessly and might hurt themselves, a straitjacket is a great tool to enforce discipline.
Right.
But if that same patient goes into cardiac arrest and you need to perform emergency CPR, a straitjacket is the absolute worst thing they could be wearing.
Because you can't move.
Exactly. It literally restricts the movement you need to save their life.
That analogy perfectly captures the profound failure of imagination among these global leaders.
Yeah.
After World War I, the global economy was in cardiac arrest. The war had completely rewritten the rules.
You had massive debts, destroyed industries.
And a totally lopsided accumulation of wealth in the United States.
Right. But instead of creating a new economic system suited for this fragile, imbalanced new reality, leaders stubbornly tried to force the world back into the pre-war straitjacket.
They demanded an immense level of financial discipline from nations that were barely surviving.
Which brings us to the four men holding the keys to this straitjacket.
The lords of finance.
Exactly. Four central bankers who operated almost entirely in the shadows.
Montagu Norman of the Bank of England.
Émile Moreau of the Bank of France.
Hjalmar Schacht of Germany's Reichsbank.
And Benjamin Strong of the U.S. Federal Reserve.
And remember, these were not elected politicians.
No. They were unelected bankers whose boardroom decisions dictated whether families on 3 different continents could afford to eat.
The concentration of power was just staggering. And the tragedy is that these 4 men were pulling in entirely different directions based on their own domestic pressures.
Let's talk about Montagu Norman in Britain.
Yeah, he was obsessed with returning the British pound to its pre-war glory.
He wanted the pound to be as valuable as it was in 1913.
But the British economy was devastated.
Right. Trying to keep their currency artificially high made British goods incredibly expensive on the global market.
No one wanted to buy British coal or steel because the exchange rate was too punishing.
So Norman was essentially sacrificing British workers to maintain the prestige of the currency.
Exactly. And meanwhile, in Alsanin, you have Émile Moreau, who was operating from a place of deep national paranoia.
Well, considering the war, you can kind of understand it.
True, but he distrusted everyone, especially the British and the Germans. So his strategy was just to hoard gold.
France actually actively accumulated gold reserves and locked them away.
Yeah, refusing to let that wealth circulate through the European economy.
And then you have Hjalmar Schacht in Germany, who is walking an impossible tightrope.
Because his country had just lived through the trauma of Weimar hyperinflation.
Where people were literally taking wheelbarrows of cash to buy a loaf of bread.
Right, so he is desperately trying to stabilize the German mark while figuring out how to pay impossible war reparations to France and Britain.
Without completely bankrupting his own country.
It was a powder keg. 3 competing national interests, all trapped within the rigid rules of the gold standard.
And the entire system probably would have collapsed in the mid-1920s if it weren't for the 4th man, the American, Benjamin Strong.
Yeah, the narrative really pivots on Strong because he essentially took it upon himself to be the global coordinator.
So Strong looks across the ocean and sees Norman strangling the British economy, Moreau hoarding gold, and Schacht drowning in debt.
And he realizes the global system needs a massive lifeline.
So what does he do? He uses his immense leverage at the U.S. Federal Reserve to deliberately keep interest rates low in the United States.
He was engineering a bailout, basically.
Right.
By keeping U.S. interest rates low, he made it less attractive for global capital to flood into America, which took the pressure off the European central banks so they wouldn't hemorrhage their gold reserves.
Let's walk through the mechanics of that, though, because low interest rates have a massive domestic side effect.
Oh, yeah, they do.
When the Federal Reserve makes it cheap to borrow money, it doesn't just help Europe. It tells every American business and investor, hey, money's cheap, go take a risk.
Right. Strong kept rates low to help Europe. But in doing so, he flooded the United States with easy credit.
He accidentally ignited the Roaring '20s.
He really did. The boom of the 1920s wasn't just driven by technological innovation.
No, it was driven by an explosion of cheap, borrowed money.
Businesses expanded rapidly. The stock market started this unprecedented soaring climb.
There was this palpable sky-high optimism everywhere, but it was entirely an illusion.
Because easy money invariably leads to excessive speculation.
Right. People weren't just investing their hard-earned savings. They were taking out massive loans to buy stocks on margin.
You could put down $10 and borrow $90 to buy $100 worth of stock.
Which is insane. As long as the stock price goes up, everyone gets rich.
But prices kept climbing, utterly detached from the actual value of the companies, fueled purely by a frenzy of cheap credit.
It feels like prescribing a heavy, addictive painkiller for a severe injury.
That's exactly what it was like.
It completely masks the immediate agonizing pain of the post-war slump. Europe gets some breathing room. The US feels fantastic.
But underneath, you are building a dangerous, hidden dependency that is going to destroy the patient later.
Was Strong aware of the monster he was creating?
He was. He was keenly aware of the eternal tension between short-term fixes and long-term stability.
Wow. So he knew.
He knew the U.S. stock market was a compounding bubble, but he believed that if he raised rates to pop the domestic bubble, he would instantly crush the fragile European recovery.
So he was personally managing this incredibly precarious balancing act, keeping constant communication with Norman, Moreau, and Schacht to keep the plate spinning.
Exactly. The entire global economy relies on this one micromanager holding it all together.
Which brings us to the massive, sudden historical twist in 1928.
Yeah, this is where it all falls apart.
The bubble in the US is swelling to dangerous levels. Europe is barely clinging to stability. And then Benjamin Strong suddenly dies.
The timing is just catastrophic.
It creates a massive leadership vacuum.
Yeah, and the delicate coordination between these central banks, which was already strained by nationalistic rivalries, shatters entirely.
Norman, Moreau, and Schacht just stop cooperating and start retreating into their own defensive corners.
And without Strong's guiding hand, the new leadership at the U.S. Federal Reserve looks at the runaway stock market speculation and they panic.
Right, they decide they have to cool things down before the bubble gets any bigger. So they reverse Strong's policy. They raise interest rates.
They wanted to carefully let the air out of the tires.
Right.
They wanted to make borrowing more expensive so ordinary people would stop taking out massive loans to gamble on stocks.
But raising rates in an interconnected global economy isn't a delicate operation.
No, it's really not.
You aren't letting air out of a tire. You are suddenly slamming the brakes on a massive speeding freight train.
Exactly. By tightening credit, the Federal Reserve didn't just slow down stock speculation in New York, they violently choked off the flow of money globally.
The cheap credit that Germany was relying on to pay its reparations dried up instantly.
The pressure inside the global financial system violently reversed. Instead of money flowing outward, the high U.S. interest rates started sucking capital from all over the world back into America.
And then we hit October 1929.
The crash.
The engine seizes up entirely. The panic rips through the system. Those investors who bought stocks with borrowed money suddenly get margin calls.
The banks demand their money back.
Right. Investors rush to sell their stocks all at once just to cover their debts. Prices collapse.
Banks begin to fail as panicked citizens rush to pull their cash out. Factories shutter.
The dizzying confidence of the Roaring Twenties just evaporates in a matter of days.
It was utterly devastating. But a stock market crash alone does not cause a decade-long global depression.
Right, because markets do correct themselves.
Exactly. The real tragedy, the fatal mistake that turned a severe recession into a world-breaking catastrophe, came from how the surviving central bankers responded to the panic.
This is the exact moment where the story goes from a tragedy of circumstances to a tragedy of sheer stubborn ideology. The global economy is in absolute freefall. Banks are collapsing. Panic is everywhere. What did the central bankers do?
Well, instead of flooding the system with emergency liquidity to keep banks afloat and businesses open, they lock the vault doors.
They focus all their energy on protecting their national gold reserves.
They kept interest rates punitively high. They actively refused to increase the money supply.
They watched the banking system burn and decided that protecting the fixed exchange rate of their currency was more important than saving the economy. I really need you to unpack the logic here, because looking back, it borders on madness.
It does seem insane to us now.
You have incredibly educated financial leaders. They're watching lines of desperate people outside failing banks. They see shuttered factories and millions of newly jobless citizens.
Yeah.
How can they possibly look at a society collapsing around them and think, well, at least the gold in the central vault is secure? How does anyone justify that?
You really have to step inside the deeply ingrained ideology of the era. These men viewed the gold standard not just as an economic tool, but as a fundamental law of nature. It was a moral imperative.
A moral imperative.
Yes, to them, expanding the money supply without physical gold to back it up was a betrayal of public trust. It was cheating the system.
So they viewed the suffering as a necessary evil.
They viewed it as a cleansing fire.
Wow.
There was this prevailing mindset, often called liquidationism, that believed the Roaring Twenties were a period of sinful excess.
So the Depression, in their minds, was the harsh but necessary medicine to purge the rotten businesses and excessive debt from the system.
Exactly.
Yeah.
They trusted their theoretical moral rulebook more than the brutal reality playing out in front of their own eyes.
And their ideological stubbornness triggered a vicious cycle known as deflation, turning a bad situation into an absolute catastrophe.
Deflation is so dangerous.
Let's explain how deflation actually works mechanically, because it's kind of the invisible killer in this story.
Yeah, please do.
When central banks hoard gold and refuse to print money, money becomes incredibly scarce. When money is scarce, its value goes up, which means the price of goods goes down.
And, deflation sounds great at first glance. Things get cheaper.
Right, but from a systemic level, it is a doom loop.
Completely.
If you know a car or a refrigerator is going to be 10% cheaper next month, you don't buy it today. You wait.
And everyone waits.
Consumer spending plummets to zero. Because no one is buying, businesses make no money.
Because businesses make no money, they have to slash wages and fire their workers.
And the debt becomes crushing.
This is the worst part. If you took out a loan during the boom years, the amount you owe stays exactly the same, but your wages are suddenly cut in half, and the value of your business is plummeted.
So you default on your loan. The bank absorbs the loss.
And eventually, the bank runs out of money and goes under, wiping out the life savings of everyone who deposited money there.
It is an agonizing, grinding domino effect. And because these men refused to untie the gold standard straitjacket, the dominoes fell across the entire globe.
They really did.
Let's look at the sheer scale of the fallout caused by this rigidity. In the United States, nearly 1 in 4 people lose their job,
25% of the American workforce suddenly destitute.
with zero social safety net.
No unemployment insurance, no federal relief. Losing your job meant risking starvation or relying on local charity breadlines.
Then you look at Germany. Their entire post-war recovery was built on the cheap loans that Benjamin Strong had quietly facilitated from the US.
Right, and when the US crashed and those loans were abruptly called back in, Germany's financial system suffered a catastrophic failure.
Major banks collapsed, industries ground to a halt, and millions were thrown into the streets.
And the ensuing economic desperation created the exact breeding ground for the deep political radicalization that would tear the world apart in the 1930s.
So Germany falls apart. What about France?
Well, France took a different path, but one that was equally destructive to the larger global system. Émile Moreau's obsession with accumulating gold actually accelerated during the crisis.
So as the world is starving for cash, France is actively vacuuming gold out of the international system and throwing it into a vault.
Precisely. By hoarding liquidity, France was effectively draining the oil out of the global economic engine, making the worldwide deflationary spiral drastically worse.
Prices dropped further, debts became heavier, and the pain deepened.
And Britain, under Montagu Norman, stubbornly tried to keep the pound tied to gold at that absurdly high pre-war value.
But the pressure became unbearable. Britain was hemorrhaging gold as investors fled.
Finally, the dam broke. In 1931, the Bank of England surrendered. Britain became the first major power forced to abandon the gold standard entirely.
That 1931 exit was a massive psychological shock, but it was also the first glimmer of hope.
Yeah, slowly, other nations realized the system was broken and began to sever their ties to gold.
But the profound suffering dragged on for years, till a massive turning point in the United States in 1933.
When Franklin D. Roosevelt took office as president.
Exactly. FDR fundamentally changed the game.
He looked at the inflexible rulebook that central bankers had worshipped for decades, and he threw it out the window.
One of his very first acts was to take the United States off the gold standard.
He finally unties the straitjacket.
Yes. Let's explain the mechanics of what happens when he severs that tie.
Well, by removing the legal requirement to back every dollar with physical gold, the U.S. government suddenly regains control of its own steering wheel.
FDR allows the money supply to expand.
The government can finally print money backed by the faith and credit of the nation rather than a shiny rock.
And this instantly breaks the deflationary doom loop.
Right. By injecting new money into the system, prices stop falling.
The government can now fund aggressive economic reforms, hire millions of unemployed workers for massive public works projects, and guarantee bank deposits to stop the bank runs.
The emergency CPR finally begins.
Confidence slowly creeps back into the system.
It's amazing how quickly things can change when you just change the rules.
The ultimate lesson here is breathtaking in its clarity. The gold standard, a system that had been universally worshipped for decades as the ultimate symbol of stability integrity, and trust.
It had mutated into the very barrier preventing human survival.
By clinging to it for far too long, these four central bankers deepened and prolonged a crisis that could have been mitigated.
Lords of Finance really proves that economic disasters of this magnitude are not unavoidable acts of nature.
No, they aren't.
They are shaped, mitigated, or catastrophically exacerbated by human choices.
I want you, listening to this, to try and put yourself in the shoes of an ordinary person in 1931.
Just imagine the sheer, helpless frustration.
Watching your livelihood disappear, your life savings evaporate when the local bank closes, your business shuttered.
And not because of a drought, not because you didn't work hard enough.
But simply because unelected men in distant rooms lacked the flexibility to abandon a theoretical academic rulebook.
Now, these four men were not villains intentionally trying to inflict pain.
No, they truly believed they were the guardians of civilization, doing the right thing by strictly following the rules they trusted.
But their fatal flaw was an absolute failure to adapt to a transformed world.
The greatest risk in a time of crisis isn't the chaos of the crisis itself.
Right.
The greatest risk is leadership's refusal to change when change is fundamentally required.
When the facts on the ground shift, your ideology has to shift with it.
If you try to force a new reality into an old straitjacket, you risk bringing the whole house down.
It is a phenomenal reminder that blind faith in any system, no matter how reliable it was in the past, is a massive vulnerability.
Let's bring this all back to where we started. We opened by talking about how terrifying it is that a global apocalypse could be caused by men in quiet rooms looking at spreadsheets, blindly trusting an outdated system.
Yeah.
So I want to leave you with a final thought, something to deeply consider long after this deep dive ends. If these brilliant, highly educated leaders unknowingly destroyed the global economy because they possessed an unwavering blind trust in the quote-unquote gold standard of their era,
Right.
what modern, supposedly infallible economic or technological systems are we blindly trusting today simply because they worked for us in the past?
That is a very good point.
What invisible rulebooks are currently dictating our lives, and are we completely ignoring the need to adapt before the next bubble bursts?
It's a chilling question that every generation has to answer for themselves.
It really is. Thanks for joining us on this deep dive. Keep questioning the rules.